Hi, I'm Brent Farley with Farley Law, and today let's talk about how owning a bank is different from owning different kinds of companies. So, owning a bank gives a lot more stability, or tends to, than owning different types of industries. But if you want to be a shareholder in a bank, it's going to require a lot more care and planning than what you might find in other industries. So, to kick things off, one of the major differences between owning a bank and other types of companies is that profitability does not assure that you are going to get a dividend. So you might want to consider that in tax planning, consider that in cash flow planning. But the fact of the matter is that you are not assured a dividend just because of profitability. A couple of the reasons for that are banking is a regulated industry. And so if you own a bank, you're going to have two, three, four, five, maybe more regulators taking a look at different facets of the organization. Now, typically you end up with two, and you might end up with one primary regulator that visits your institution from time to time. But the thing to be aware of is that the regulator has the authority to suspend dividends if there are certain types of problems within the bank or if there are significant problems at the bank. So if there is a regulatory violation that's serious, or if there is a financial problem with the bank and it's serious, the regulator can step in and tell the bank to not pay dividends to the shareholder for a period of time, and that might be an extended period of time. The other thing to be aware of is that banks have capital requirements. They have to hold certain levels of capital, and if they don't, they can put the bank in a troubled financial standing with regulators. It can also cause the bank to fail. And so if the bank is in a position where paying a dividend would jeopardize its capital ratios, it's not going to be able to pay the dividend. And that's true regardless whatever tax liability the shareholders might have with regard to their ownership in the bank's stock. So something to be aware of. If you want to be an owner of a bank, you need to start looking at capital planning, being aware of your bank's capital position. You also need to be aware of how well your bank is doing in complying with regulatory guidelines and the law and guidance and directives from regulators. So really important to keep track of that. The other thing to be aware of is that bank activities are limited. In most companies, if you want to take on a new activity, you might talk about it for a little bit. You might have a director's meeting, and then you'll pursue that activity. So something as simple as, let's go buy a piece of land to serve as a future office or serve as a future headquarters for our company. You might want to take a careful look at that if you're a bank, because banks are limited in the types of real estate investments they can make. And if a real estate purchase looks speculative, it might not be allowed. So in general, when you're thinking about banking and banking activities, banks are going to be limited to financially related activities. Now that scope is fairly broad, but you'll want to think about lending, payments, deposits, insurance, and some activities with securities. And if you stray outside of that realm, you might be able to tackle the activity, but there's a good chance that you can't. So you're not going to own a construction company as a bank. You're not going to own a real estate investment company as a bank. A bank holding company can hold a venture capital fund, but that comes with some restrictions. And so if you have a holding company, if you're engaged in real estate investments, if you're engaged in owning other companies, which many bank shareholders are, you want to make sure that there's clear separation between your commercial activities, the non-banking activities, and the banking activities, and that the ownership hierarchy of the companies you own don't end in the same place for the banking and in the non-banking activities. So that's very important to keep track of. There are a few exceptions to that in the banking world. There are industrial bank charters and industrial loan charters, but those are difficult to get. They're pretty controversial. Next thing to be aware of. The next thing to be aware of as bank shareholders, if you are a significant bank shareholder, you hold 10%, a 10% interest in a bank, you hold a 25% interest in a bank, you're probably going to be submitting biographical information to a bank regulator for their review. So biographical information means background check. If you can't be just anybody and own a large stake and a controlling stake of the bank, There's going to be some limitations on what can show up in your background because banks are insured by FDIC insurance. If you hold a position that says you're going to have some say in the direction of the bank might be interested in your resume, in your banking experience, your financial services experiences, and in your history with other bank regulators or other regulated industries. So jumping in and taking a controlling ownership interest in a bank is just not quite the same as taking a controlling interest in another company. Now, if you have no banking experience, that can still be okay, but the regulator is going to be interested in who your management team and directors are, and may be a little hesitant to just give you free reign over what the bank is doing in general, and may want you to rely on your management team to help direct the bank instead of just directing it completely on your own. Other thing to be aware of: shareholder groups and changes. So there is a law called the Bank Holding Company Act. It's been around for over 100 years. And what the Bank Holding Company Act in general says is that a controlling group of a bank, whether it's a corporation or it's a partnership, or it could also be a trust and other types of entities that look like a corporation, act like an association. If that group holds 25% or more of an interest in a bank, they have to apply with the Federal Reserve to be a bank holding company. And that includes a lot of the same types of application materials that you would have to submit to become a bank. It's not really quite the same, but a lot of the interest in the same. The Federal Reserve is going to be interested to know how much stability the bank holding company is going to offer the bank, how the bank holding company intends to run the bank. And after you become a bank holding company, you're going to be subject to a number of reporting requirements. That's financial reporting requirements, there's changes in ownership, and there's other types of reports that would go to the Federal Reserve. So if you want to be a controlling owner of a bank, and you want to do that in concert with other people, you need to take a careful look at the Bank Holding Company Act and make sure you're not running afoul of it. Some of the ways that people get tripped up with bank holding company applications is a group of shareholders, maybe a family, might start a family trust, or they might start some kind of family partnership. Now, that's not impossible, but in some circumstances, that trust or that partnership can be looked at as a bank holding company and would be subject to all the rules regarding bank holding companies, including notices, including all the reporting, including oversight from the Federal Reserve. Most shareholders in that instance don't really want that level of oversight. So there are ways to step around that. However, there's something to be very aware of if you are an owner in a bank and you're starting to work with others to try to control the bank. You want to be careful how you do that. That thought extends to shareholder agreements and voting blocks and other instances where you might aggregate control over a bank. Notices of change in control fall in line with that concept. And so if you're an owner of a bank and you have a 10% interest or 25% interest or more, you're probably going to need to submit notices of change in control when you're selling that interest or acquiring that interest. So before you step into a bank and buy a large interest in the bank, you'll want to understand what your notice requirements are and what your biographical submissions might need to look like, and be careful and do some planning in that regard. So that topic extends right into estate planning. Typically, a bank shareholder will have significant other holdings, and there will be a good reason to do some estate planning and some family and gift planning. As you are preparing the estate plans and as you are executing on the estate plans, you need to be aware of rules regarding notices of change in control and rules regarding the Bank Holding Company Act. It's very easy to forget a notice. It's really easy to forget an application, and the fines related to failing to file those types of applications are very significant. It can be daily fines. It can be tens of thousands of dollars in early stages. It can be over $1 million. So in conclusion, being a bank shareholder is not like being a shareholder in other corporations. You need to do some more planning. You'll need to do tax planning. You'll need to make sure that in your capital planning, the bank's going to be strong in its capital positions so that you can continue maintaining dividends. You want to make sure the bank is in a strong regulatory position, or it may not be able to pay dividends. And you'll want to do some advanced planning and exploration before you try to take control of a bank and before you do some estate planning. Now that being said, owning a bank does require more careful planning in advance, but also owning a bank, because they're regulated and because they have to be methodical in their approach to things, they do tend to be much more stable investments than other types of investments in other industries. Thanks, I'm Brent Farley with Farley Law, and that's how owning a bank can be different from owning